Hi there, everyone. Welcome to MPC Markets, quick investment explainer on buy the dip in the S&P 500 index. Now, I'm not going to bore you with all the, with all the general, investment thesis around, why we should be buying. I think everyone's really familiar with index buying and dollar cost averaging, etc., over the long term. But we'll just get some of the business end out of the way. This is a general advice warning. Content presented is intended for informational purposes, provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. Please note that the stats quoted in this, and the past performance is not a reliable indicator of future results. This product involves derivatives, and 100% of the capital invested is at risk. Okay, so I'm going to start with how buy the dip works. As I say, I don't need to explain index investment. The index is obviously very reliable. S&P 500, underperforming stocks get booted out, new ones come in, etc., etc. But how buy the dip works and where this is very unique is people have a real issue with timing, and how most planners and most brokers solve it is dollar cost averaging, etc. This product is over 3 years, a 3-year S&P 500 index investment, and it has what's called a 6-month look back window, which we've run a bunch of statistics on this. The middle of May to the middle of October is the best 6-month period, the most underperforming 6-month period to be getting into this type of index investment, and that's where the old adage is. Sell in May, and then the Santa rally come from, which is, we're all very familiar with, very fond of those sayings. But basically how this works is within that you invest as of the 15th of May, and then over the next 6 months, you get the lowest settlement of the S&P 500 on the Thursday of every week. So you're a very good chance of capturing the dip. Thursday seems to be the weakest day in the last 2 years overall in the S&P. We ran some stats on that as well. And essentially what we want to do is, look, September is generally the weakest month. While October isn't necessarily a very weak month, it quite often does capitulate in the early part of October and then bounce out. So it is one of those things where this is more of a statistical argument on getting you the best entry to the S&P 500 and then leaning on those, those average performance indicators where, you're gaining that sort of 12% per annum return. The way it does this as well, there is some leverage involved, which is via options and derivatives. So we're going to talk in terms of cash invested and notional invested as well. So this particular investment, you put $17,000 down in cash. 100% of that capital is at risk. However, you get 100,000 notional exposure to the index beyond 17%. So that's how you pay for your leverage, essentially. Now, if we've got a 12% per annum index, you're going to end up with 36% over the course of 3 years. So where the 100,000 kicks in is from up 17%. So you would basically then get that, get that the rest of the 19%, but treat it as if it was $100,000. The first 17% goes to repaying back the capital you've invested. So if you're up, say for instance, you're up 10%, or halfway to 17%, you're going to get half of your cash back. If it is down, you don't get any of that cash back. So what we generally recommend is don't invest in this what you would invest in cash. You would invest in this what you would invest in cash normally if you were going to buy $100,000 of the index. Only invest the 17,000. So that is really how you want to handle the leverage here. So then you've only got 17% of the notional at risk. Okay. So and then look, and the great thing about it is we all look at buying the dip in hindsight. The great thing about this is you don't need to pick the bottom. The look back does it for you. So then you don't have to worry about the timing. So it's sort of perfect hindsight on your entry price, and there's no timing required. And I mean, how many of us have looked at those dips and then gone, oh, I should have bought it that day, etc. And we haven't. Look, I've been in markets 30 years. It happens time and time again. Even to those of us who have seen it all. So now, why we're looking at this is, at the moment, there are a number of things that are at play, whereby we don't want to be allocating here. Where it's currently only the 15th of April. We're roughly about 12 points from the S&P's record high, and we've got oil prices around $90. We've got bond yields still up about 30 basis points since this Iran conflict started. And we're starting to get back to sky-high valuations now across the S&P in total, broadly across all 500 constituents. So the Schiller Cape is a PE that's that's stretched over a long period of time. It's currently nearly double its overvalued threshold. Trailing PE is 9, 29.5, above 20 is overvalued. Forward PE is at 20. It's only slightly overvalued. And then the Buffett indicator, which is a market cap to GDP thing, is essentially always overvalued above 150%, and it's currently at 217. So these are some of the most overvalued, sort of stock prices in history. So we don't want to be buying stocks up here at the moment. There's a lot of uncertainty. We could have this conflict drag on. We could have oil prices remain up here, which will then feed into inflation, which can both dent growth and then stop the central banks from actually cutting rates. So yeah, really is one of those scenarios where sitting in your hands is kind of the right thing to do. The thing about rebounds as well, and why we like the buy the dip feature within these index investments, is the rebound happens faster than has ever happened before. So pre-2015, bounces back from bear markets used to take anywhere, a year and a half sometimes. Lately, post-2015, the bounce back to where it started from is only 127 days. And positive returns in rolling 3-year windows is 83% of the time since 1928. And then the average rebound across 11 major corrections over 24 months is 41%. So that obviously gets you your more than pays for the 17% of the notional you put up front, or the cash you put up front. And then you're starting to kick into that, those leverage returns. So, but the absolute breakneck speed at which this happens makes it incredibly difficult, particularly if you're not just even if you're sitting in front of it on a daily basis. It makes it very difficult because the panic feels real. If you've got a job, and if you've got a life, and you've got children and things like that, and you're not watching the market, I mean, it's near impossible. You'd have to just be very lucky. Another thing here is, and this is a real kicker, particularly for this year, and this only happens once every 4 years, is we've got the midterms in November this year. Since 1939, basically we've had a pullback on average of nearly 17% from the highs during a midterm year, the 12 months, so last November to the November coming. And you can have a look at some of these. 78% of them have occurred in this window of May 15 to October 15. The average 1-year return from those lows is 36%. Strongest recovery, 66. The worst recovery has been 11. So and midterm positive year rates is 86%. So it will generally nearly always bounce out of those lows. But obviously, uncertainty around elections, Trump's not doing well on the polls, etc. It usually means that there's some type of concern and a bit of a capitulation during the lead up to the to the midterm elections. So Trump, I believe, the people talk about the Trump put, where basically he supports equity markets, and that is realistically, as some speculate, his long-term goal is more so to enrich his family than necessarily be president. And he often brags about how the S&P was up 70% the last time he was in office. He'll be aiming to do that again. I would imagine he can't be re-elected. So you would imagine that, he will throw anything at this to get it, to get it to rally in the last couple of years, and that's why we've chosen that 3-year time frame. So he won't be president in 2 years and 9 months, but getting towards the end of this strategy overall, the cost to exit is negligible, and you should be more than in the money. So you can exit this early. The earlier you exit, probably the higher the penalty. It is an OTC product, and you are at the mercy of the product provider. However, as you get towards the end, of the 3-year term, like I said, those exiting is not a big issue. It's not necessarily T+2, but look, you would probably look to receive your cash back, in somewhere between 5 and 10 business days. So overall, I mean, that particularly puts it over the top. This is a strategy we do, most years, and all we're doing is playing into the reliability of the index, and obviously, those taking advantage of those statistical periods when to enter. So you've got valuation at highs, you've got clustered risks, recession odds are going up as well. The midterm dip, which bats at 100% since the 1930s. You're getting around about anywhere from 6 to 7 times leverage. It auto locks the lowest price on that weekly Thursday close, and then you're likely with the Trump put get policy tailwinds, leading into the back half of his 4-year term. So this is really this is one of these ones where most people have ETF and index investments. This is a capital efficient way of approaching it. It caps your downside, and as I say, the statistics and that entry functionality really lean into you absolutely squeezing as much out of it as you possibly can. So if you want to know more information or you want to apply to buy the dip, you can scan this QR code now and fill out your form and upload all your details, etc., and let us know. The strike date will be May the 15th, but you'll be able to invest, and you'll pay for the investment leading into it. The reason it is that is just leaning into these statistics. So you don't want to go too early, and because there was quite a few of those midterm dips that were around the 10th to 15th of October. You want to be timing this properly and leaning on the stats, and that'll also give you some time to take advantage of selling any index ETFs you've got at the moment, and fund your investment in this. So thanks for listening, guys. If you've got any questions, just let us know. My email is mark.gardner@mpcmarkets.com.au, or you can just hit us up on the website. Thanks.
Feeling lost with investing? Meet Mosaic. Mosaic is MPC Markets' platform that turns confusing markets into clear, actionable guidance for your portfolio. Discover Mosaic today. Portfolio and trade ideas in one place for clients and subscribers, powered by MPC Markets.